Imagine waking up one morning to news that sends shockwaves through the global economy. Not in stocks or crypto, but in a commodity that most people only think about as jewelry or old coins, silver. In the space of just 48 hours, markets around the world began to behave as if a tectonic plate had shifted under the fragile foundation of global supply and demand, unleashing what traders, analysts, and even tech magnates began calling silver chaos. It started with a quietly brewing storm that nearly nobody saw coming, a dramatic surge in demand that pushed silver prices to unprecedented heights, 26 times stronger than what the world had factored into 2025 forecasts, and a near total ban on exports from one of the most important players in the entire silver ecosystem, China. In the early hours of the crisis, electronic boards in New York, London, Shanghai, and Mumbai lit up with price movements that stunned veteran traders and sent alerts across every financial app on the planet. Silver. A metal that had spent much of its recent history in the shadow of gold's gleaming spotlight suddenly became the hottest asset on Earth, and not because it was a speculative fad, but because something fundamental had changed deep inside the global metals markets. Over the course of 2025, silver had already been climbing, driven by sustained demand from industries that needed it for solar panels, electric vehicles, data center electronics, medical devices, and green technologies, so much so that inventories were thinning and physical premiums in key markets began to spike. But what was happening in late December and the very first hours of January 1st, 2026, was on an entirely different scale. When global markets closed on December 31st, reports began to circulate from major news outlets, trading desks, and social media feeds. China's new export licensing regime for silver had taken effect. Under rules that required government approval and stringent thresholds, only a small group of large state-approved Chinese companies could export silver, essentially throttling the outbound flow of the metal that accounted for roughly 60-70% of the world refined supply. Overnight, supply that had once been relatively fluid and tradable across borders became tightly controlled, heavily regulated, and, in the eyes of markets, dangerously constrained. Overnight, silver went from being a steady, slowly appreciating industrial commodity to something more akin to a strategic resource like rare earth minerals. This was a rumor. It was confirmed by government announcements and multiple market sources, and the implications were colossal. Imagine a global system where the piping that carries oxygen to the heart suddenly narrows. Prices will spike, panic begins, and every part of that economy feels the strain. That was the silver market in the first 48 hours after China's export regime kicked in. Prices on some exchanges surged above $80 per ounce, eclipsing record levels not seen in decades, and dwarfing silver price at the beginning of the year, which had been languishing near $29 per ounce. In certain physical markets, like Shanghai's physically delivered contracts, the premium above paper prices exploded, signaling that real buyers, manufacturers, and industrial consumers were desperate to secure deliverable metal while they still could. Even basic arbitrage mechanisms that typically keep prices aligned across global venues began to break down, a clear sign that the fundamental balance between supply and demand was in chaos. Market analysts started muttering about parallels to historical commodity squeezes, not the artificial cornering attempted by the Hunt brothers in 1980, but a structural shock driven by genuine industrial demand and a sudden withdrawal of export supply. As prices ripped higher and volatility surged, traders saw movements that most had never witnessed firsthand. In 1 hour, silver might blast up 7 to 10% on supply fears. The next hour, it would retrace sharply as short-term traders capitulated or profit took. What was clear to everyone, however, was that the old rules no longer applied. This was a new regime. Rumors and real policy actions blurred together as Washington, Beijing, and global financial centers scrambled to interpret what the sudden scarcity meant for everything from manufacturing timelines to inflation indicators. Industrial giants that rely on silver for photovoltaic cell production and semiconductor wiring suddenly faced a reckoning. Either pay sky-high premiums now or risk production delays and cost inflations that could ripple down the entire value chain of renewable energy and tech hardware. Meanwhile, investors who had previously shunned silver in favor of gold or equities found themselves caught between fear and opportunity. Central banks, always mindful of precious metals as inflation hedges, began adding physical silver alongside gold to their reserves, pushing demand even higher and intensifying the squeeze. Gold itself was setting records, above $4,500 per ounce, but silver's trajectory was steeper, sharper, and more chaotic, producing a spectacle that looked at times like mania and at others like an industrial awakening. Amid the noise and the headlines, even powerful voices in the tech world took notice. Elon Musk, a figure known for high-impact commentary on markets and technology, warned publicly that the record-high prices of silver could have serious negative consequences for manufacturers who needed it as a core input in electrification and energy technologies. His message was clear. This wasn't just about trading profits, it was about real-world supply chain risk. As the first 24 hours ticked by, momentum built toward a consensus among many traders that silver as a volatile breakout was no flash in the pan. Instead, it was the harbinger of a new commodity regime in which physical scarcity, geopolitical policy, and technological demand collided. Markets that had been relatively calm fractioned into bifurcated worlds. The paper silver pricing on futures and ETFs, and the physical silver reality of deliverable stocks and spot premiums. In some corners, the gap between these two measures widened to levels not seen in decades, illustrating the fundamental disconnect between theoretical valuation and physical availability. By the end of the first full day after the export rule took effect, exchanges that process physical delivery reported a dramatic tightening of stocks. Warehouses that held readily deliverable silver saw inventories plunge, while premiums in active physical markets climbed sharply. Traders began speaking of vault drains, where metal seemed to be pulled off the market faster than it could be replaced. This wasn't just about hedging or speculation. Legitimate end users were scooping up metal because they needed it for production and were willing to pay steep prices and immediate premiums to secure supply. At the same time, margin requirements on futures contracts were being raised by major exchanges, driving out some speculative participants and tightening the market significantly. This move, meant to prevent excess leverage and risk, had the side effect of forcing many traders to either post more capital or liquidate positions, which amplified price swings and added to the unpredictability facing the market. The ferocity of this 48-hour upheaval turned everyday investors into silver market obsessives. Social media channels lit up with charts, predictions, countdowns, and fear of missing out posts. Traders compared the situation to a modern bank run, but instead of cash flowing from vaults, metal was moving into them, into private holdings, and into industrial inventories at a pace that defied historical precedent. By the time the second day drew to a close, silver had etched itself not just into financial headlines, but into broader economic discourse. Newspapers, financial news networks, and business analysts across continents were wrestling with the implications. What does it mean for currency markets when a precious metal so pivotal to emerging technologies enters a supply shock? How will manufacturers adapt when a once cheap conductor now carries the weight of geopolitical strategy and export protectionism? And perhaps, most importantly, how long will this chaos last? If you've been watching these developments unfold, you know this story is far from over. And if you want real-time updates, deep analysis, market breakdowns, and expert interviews on what might come next, then make sure you subscribe to the channel and hit the notification bell so you never miss a moment of this global financial saga. Because in times like these, the difference between profit and loss, certainty and confusion, is being informed, prepared, and ahead of the crowd. As the second 24 hours unfolded, the silver market transformed from a high volatility spectacle into what many analysts began calling a structural upheaval, a scenario in which every trader, manufacturer, and investor realized that the rules had changed forever. The initial panic of the first day gave way to deeper strategic calculations. The 26.6 spike in demand was not an anomaly to be shrugged off, but a signal that physical silver was suddenly a finite high-stakes resource whose movement and availability could dictate entire supply chains. Industry insiders revealed that companies producing photovoltaic cells, semiconductors, and electric vehicles were scrambling to secure contracts with trusted suppliers, even as spot premiums soared to levels not seen in decades. Warehouses in key hubs like Shanghai, Hong Kong, Dubai, and New York reported unprecedented withdrawal volumes, with some stocks vanishing almost entirely from the market, triggering a global scramble among legitimate buyers. Traders watching paper silver contracts were astounded as the divergence between futures prices, and physical premiums widened to historic levels, a stark signal that tangible, deliverable silver had become more valuable than any speculative paper contract. This dual reality, the theoretical price versus the physical price, became the focus of financial commentary, as experts warned that the arbitrage that once kept markets stable was now under stress, and in some cases, completely broken. As news outlets broadcast the surge, hedge funds, high net worth investors, and retail speculators all moved quickly, trying to secure positions in either paper, silver, or physical bullion. The rush intensified when reports emerged that China OS export ban was likely to remain in effect for an indefinite period, forcing market participants to adjust strategies, hedge risk, and consider long-term allocations in silver that could extend beyond typical trading cycles. Governments began to watch the situation closely. Central banks in Asia, Europe, and North America evaluated the implications of restricted silver flow on industrial production, currency stability, and inflation hedging. Some nations began quietly adding physical silver to their reserves, an action that further tightened supply and amplified upward pressure on prices. At the same time, news emerged that certain Chinese state-approved firms were selectively releasing limited quantities of silver under special licenses, creating an uneven supply pattern that added to market volatility. Traders coined the term silver drips, referring to the sporadic and unpredictable releases, which fueled frenzy among industrial buyers who could no longer rely on traditional supply chains. This situation created a ripple effect across multiple sectors. Electronics manufacturers faced delays and cost escalations. Solar panel producers recalculated project timelines, and EV manufacturers began scrutinizing alternative materials for wiring and battery components. Analysts began to model worst-case scenarios, considering the global economy as increasing dependence on silver as an industrial metal rather than a traditional commodity. Unlike gold, which historically functioned as a monetary hedge, silver had become a critical input in the infrastructure of modern technology, and its scarcity could have cascading effects across energy, automotive, and tech sectors. The broader markets reacted accordingly. Equities in companies heavily reliant on silver saw sharp swings, resource stocks surged, while tech manufacturers vulnerable to supply disruption experienced immediate headwinds. Commodity ETFs tracking silver exploded in volume, and smaller investors were drawn into what felt like a once-in-a-lifetime opportunity to ride a historic metal surge. Social media and financial forums became floodgates of speculation, rumors, and real-time updates, creating a digital echo chamber that further amplified demand pressures. As analysts debated whether the spike was temporary or structural, the answer became clear. This was not a simple flash event, but a fundamental shift in the global silver market driven by both China's export policy and an unprecedented industrial demand surge. Meanwhile, major exchanges were forced to adjust margin requirements, daily limits, and trading halts to maintain stability. Some exchanges even temporarily suspended new futures contracts to prevent extreme speculative blows, which only intensified the market's anxiety and drew attention from regulators and policymakers worldwide. The 48-hour window had now passed, and while the initial frenzy had slowed slightly, the consequences were just beginning to be understood. Logistics experts highlighted how physical delivery challenges, limited ports, tight storage, and transportation bottlenecks added real constraints to availability, meaning that even those with financial resources could struggle to secure actual silver in a timely manner. Major manufacturers began exploring alternative strategies, hedging with derivatives, securing long-term contracts with premium pricing, and even accelerating research into synthetic or substitute materials to mitigate production risks. In parallel, geopolitical observers noted that the silver shortage might have ramifications beyond economics. China's export policy, framed as industrial protectionism and national resource strategy, positioned the nation as a decisive player in the global silver supply chain, demonstrating how commodity control can be wielded as a tool of influence in global trade. Governments dependent on Chinese silver found themselves in a delicate balancing act, negotiating access, seeking alternative sources, and preparing contingency plans for industries critical to their economies. This intense scrutiny extended to global financial media, where commentators dissected every minute detail of market movements. Headlines screamed terms like silver squeeze, white metal panic, and industrial blackout risk, creating a sense of urgency that propelled both institutional and retail investors into action. Even the historically conservative bullion community was caught up in the momentum, with investment in silver coins, bars, and ETFs skyrocketing within hours. Analysts pointed to a fascinating feedback loop. The more the media amplified the crisis, the more physical demand rose, which in turn reinforced price spikes, fueling more coverage. The phenomenon resembled a self-reinforcing market storm where perception and reality collided in real time. As industrial users, traders, and investors struggled to adapt, the global dialogue shifted toward risk management. Experts began discussing the long-term implications for portfolio allocation, supply chain resilience, and industrial diversification. Some suggested that silver SI's newfound scarcity might permanently reshape global strategies around renewable energy and electronics manufacturing, effectively forcing companies to rethink production design, sourcing, and pricing models for years to come. In parallel, stories began to emerge from individuals and small investors who saw silver not just as a financial asset, but as a tangible hedge against an increasingly unpredictable global economy. The human element became part of the narrative. Manufacturing CEOs negotiating urgent deliveries, investors watching screens as volatility charts spiked, and ordinary people lining up at local bullion dealers, all experiencing the very real tension of a world in which a single commodity could suddenly dictate fortunes and industrial outcomes alike. Amidst this chaos, one message became abundantly clear. Preparation and knowledge were now more valuable than luck. Those who understood supply flows, export restrictions, industrial demand, and market psychology had the advantage. Those who reacted purely emotionally faced risk of severe financial loss. By the end of the second 24 hours, silver's story had moved from panic to strategic recalibration. Markets were still volatile, But the narrative had shifted. This was a new world for the white metal, one in which global supply chains, industrial dependence, and investor behavior were irreversibly intertwined. Traders and analysts predicted that the effects of this 48-hour event would ripple through months and potentially years, with prices eventually stabilizing only once new supply routes, inventory adjustments, and industrial innovation caught up with demand. As viewers, understanding this story is not just about watching numbers move on a screen. It's about grasping the intersection of policy, industry, and human behavior that shapes our economy in ways most people never see until crises occur. And while we've explored the chaos, the strategies, and the consequences in this video, there's much more analysis, live updates, and expert breakdowns still unfolding as this story continues to evolve in real time. That's why staying informed is critical. To ensure you never miss the next explosive development in the silver market, whether it's a new policy, a price spike, or an industrial twist, you need to subscribe to the channel and hit the notification bell. By joining this community, you'll gain insights that go beyond headlines, access expert commentary, and be ready to act when global markets shift in ways that directly impact your investments, business decisions, or financial strategy. This silver surge is more than a market event. It's a window into how geopolitics, technology, and economics collide in ways that define wealth, opportunity, and risk in our lifetime. As the world watches and reacts, the next moves will be decisive, and knowledge will be power. Stay ahead, stay informed, and become part of the discussion. Because the story of silver chaos is just beginning, and the next chapter could redefine markets as we know them. Subscribe now, because in times like these, being prepared is everything, and every second counts.